how much do you think, if there are further problems in the future for Credit Suisse, that Mr. Gottsteins' position itself may become untenable?
Yeah, I don't think it is at the moment, although the bank still is struggling to find its real place in the new environment. And that's, we can look back over the previous management there, where it's really still been looking to find its correct role, what its niche is, and how it's pushing forward. But I think what they definitely need to do is really provide greater detail on what they're doing. We need to look to see who the new head of the investment bank is going to be, and in particular, how they're going to put in place a chief controls officer, perhaps reporting directly to them, and really tackling this issue.
Well, looking at where the stock price is trading on a price to book value, price to earnings value, we have Credit Suisse shares trading at around 6. Its closest comp is UBS, they're trading around 9. So a third of its profitability essentially being wiped out because of the recent events that the bank has been wrapped up in. Do you think that that is fair, that investors are pricing in a permanent hit to its profitability going forward, even though you could make the case that many of these incidents were just one-off?
Yeah, that's an interesting one. So, I mean, our role isn't really looking at the actual valuations, but what I can say, looking at the past, is that we can see that the thing that investors definitely hate is uncertainty. So here we have an uncertainty about what the actual exposure is at the bank, uncertainty about the quality of the control processes and so on. I think it's a real message actually more broadly to investment banks operating in this space, and indeed to the analyst community themselves, which is needing to have a real understanding of what these one-off risks look like, the extent to which the bank has control of them, and how they can improve transparency there. Now, it's certainly true that banks have been focused on this kind of area, and indeed we look at the staffing in the risk and control functions has grown significantly. So over the last kind of 5-10 years, the staff numbers there have more than doubled. So this is an area that banks are looking at, but it is still something of a black box, I think, for many investors.
Well, I mean, one of the big issues of this whole situation with Archegos is a lot of the prime brokers just simply didn't know how much exposure they had and how much leverage this fund was actually running. And part of the problem was that it was engaging in these total return swaps. So it gave them a cover to not give full disclosure of the underlying positions. To what extent do you think is that going to be a challenge for regulators to deal with in the future, and in terms of how they think about derivatives and not just in the context of full cash positions, how they can bring that onto a broader remit of how prime brokers think about their overall exposures and positions to funds that they're extending leverage to?
Yeah, so I think it's really easy to blame the product. And indeed, we've seen that in going back to the financial crisis, where either derivatives or securitization was claimed to be the cause of the crisis. I think what it really comes down to is for each bank having a real understanding of their clients, what their clients are doing, and do they want to do that business. And to some extent, that goes beyond the rules. It's very easy if you're a bank there saying, look, we're following all the rules, it must be fine. But I think it's Bill Winters, who used to run things at JP Morgan, now over at Standard Chartered, would say, look, if you're following more than that and really getting behind that and understanding what the principles are, is this the right business to be in? Are these the right clients to be doing business with? That whole ethics side, that competence is really the one I think in which we should be focusing on.